Good morning and welcome to Clinical Trader. It's been 2 or 3 weeks since I made a video and I wanted to just do an update on some of the action going on in the markets. Today's date is the 12th of February 2022, and in this episode we will briefly take a look at the Ukraine-Russia saga. We'll then take a look at a new development that occurred last night in the US, in which we have emergency Federal Reserve meetings taking place on Monday, which would be Australian Tuesday overnight. And these meetings are rare, so we'll take a look at that real quick. And we'll take a look at the S&P ASX All Ordinaries Index, do an update from last time, and we'll take another look at US Treasury bonds and see what they've been doing since we presented our last video. And interestingly, this week, gold breaks out of the downtrend and had a big night last night. So we'll take a look at some charts relating to that, and of course the fact that silver will follow. So stay tuned as we take a look at the markets in recent times. All right, so tensions have been rising in parts of Europe, and specifically we're talking in Eastern Europe, and we're looking at Ukraine and Russia. And look, tensions have been building for a little while, and I do expect that those tensions will remain high. I do note that it was yesterday in America, they sort of said, well, we do think that Russia will invade Ukraine next week. And rumors are that that spooked the markets, which caused a bit of a sell-off last night, which is possibly true, but we don't really know that. So Russia apparently has assembled a huge, like a 70% of the military capability around the border of Ukraine, and have threatened to, well, they haven't threatened anything actually, it's the US that's doing all the talking, and we will wait and see. It seems to me like Russia, I don't think they will invade. I think this is one of those very common occurrences where it's a case of look over here, don't look over here, because that's just how markets operate. So will Russia go into Ukraine? Look, they probably have geopolitical reasons too. They're a bit worried about what's happening in other parts of Europe and being basically squeezed by NATO. And they may not. I just think they're looking for respect. I think they're looking to get a bit of, power by, posturing. That's all this is. It's just posturing. I don't think there'll be any sort of invasion. The threat's been there a while. Look, Russia has invaded Crimea and taken back the peninsula, but they had real strong geopolitical reasons to do that. And I'm not so sure that we'll see the same again. And I could be wrong. Maybe they will. And I think if they do, markets are in big trouble. But they're just not feeling it. So, markets sold off at around about the same time. But is that the reason we had the sell-off? I'm not entirely convinced that's the reason. I'd say that probably a bigger reason is this heading that we have here from Zero Hedge. Why is the Fed suddenly holding an unscheduled, expedited, closed board meeting on Monday? An unscheduled meeting. So normally these meetings take place once a month. They go for 2 days, and then there's a press conference and they talk about what's going on. But they had a press conference last week, so we're a long way from the next meeting. I guess the question is, what's encouraged the Fed to suddenly make an unscheduled meeting? Was it the high consumer price index that came out last night? No, the night before? Maybe it was. I think they registered 7.5% CPI over the same January period of last year in 2021, which is a fairly significant move, but not unexpected. So anyway, the point of this article here is that certainly the last time the Fed did hold an unscheduled, expedited, closed board meeting, very soon after, as you can see by this sort of gold-coloured dotted line here, very soon after, the Fed hiked rates. So that's a little concerning for markets. And you can see that the Fed hike rates persisted, multiple times as they tried to I guess, take the quantitative easing out of the system. But of course, we get up here and all of a sudden it wasn't working. At the same time this was rising, we had markets tanking. So actually probably later, more so later in the cycle. And then of course they reversed and they came all the way back down. And they've been down here ever since. And here's that meeting schedule for Monday. Will this have an effect on markets? Yeah, probably. Interesting that it does coincide with those, that threat of Russia going into Ukraine. So we got a really exciting week next week. That is for sure. All right, we'll look on to the next part here. We'll look at the All Ordinaries Index. Last time I put a video together, we had this chart and I pointed out that markets had rolled over for 3 weeks. So that was week 1, 2, and 3. And I said that if we get down to this region, that we would likely bounce off that uptrending green line, which was parallel to this line, which connected these highs. Well, guess what? We nearly got down to the line, but it's close enough, and we did rally off that. And you can see that this week, if we zoom in, that we opened here. Markets in Australia went higher, really pushed higher aggressively, got up to here, and then pulled back to finish on Friday at 7,518. And you could say that it's a pullback after breaking out above this line. However, we need to factor in what's happened on last night's markets. So Monday, particularly if some news comes out over the weekend, we could see this roll over. And I think if that did happen, that's a very, very much a failed breakout. And I'd say we're definitely heading lower, probably back down to this green line here and see where we are at that point. If this breaks, I'm afraid to say we're going quite a bit lower. And that will be very challenging. We may get a break below the line. We could see support here for a little bit, but in the end, I think we'll see it roll over and head lower if that can't hold. Next level of support in my mind is this 200 week moving average. That would provide the next level of support. Will it hold? Well, you just need to see what happens at that point. Certainly coming up in the next few weeks and the months ahead is, of course, those rate hikes that the Federal Reserve of America has been threatening for quite some time. So keep your ears posted on that, and hopefully I'll get another update as we work our way towards that end game. Is it possible we could keep rallying here? Certainly geopolitically and politically and economically, it's not looking likely. We've seen high inflation. The Fed's behind the curve trying to fight it. And I think it's tongue-in-cheek stuff. On one side, they're saying we are fighting it. We've got tools. We can do what we need to. On the other side, they really don't have much they can do except to reduce rates again. In essence, maybe the aim for them is to raise rates a few times so that they have ammunition to then drop rates as things get pretty bad, or negative, I should say. So that would be that rollover. We'll have to wait and see. I'm pretty confident that's probably the plan ahead, and we won't be proven wrong or right until time passes. Okay, we also spoke last time about yields. So we had this chart up and I spoke about tapering. This is when tapering began. We had that rally in bond yields, bit of a pullback. Then stocks sold off while yields were rising. And stocks really have been bouncing around since this time. I guess you could say that I was expecting that as the tapering continued, we would see stocks sell off even further, perhaps down to this area in here. But of course that hasn't happened. In fact, yields have gone even higher. And this really should have spooked markets, this rally in here. So they didn't, okay? This one here. Rally. Make that green. Okay, yeah, so we got the rally in yields. Markets have been sort of up and down, haven't really done too much. We'll have a look at that in a minute. Sorry, no, we already looked at that. But they've been up and down. Yields are up. Interestingly though, and I guess the reason why I make this video now is that what we have here is this big red bar. This is the daily chart. So this is Friday, the 11th of February. So that's one whole day. So you had this big spike the day before, and no thanks. We don't want to be up here, and it actually retraced. Now this pattern here is called an engulfing pattern. It's very bearish. So you would expect, based purely on the chart, that we're probably going to head lower from here. But of course, with CPI so high, there will be some resistance to that trajectory, and I guess we'll have to wait and see. But at this point, this is a big rejection candle for higher yields, which is a little concerning, I guess, if you're in the stock market, and that supports those lower prices we spoke about here. Okay, so that's ahead of us. The yields, I've only shown the US 10-year yield. We've also seen the 2-year yield rally really significantly. The 2-year yields, I think, I should have checked, but it's currently at around, I think about 1.7% maybe. But it's rallied really hard. I think it's up something like 80% in about 6 months. So, you know, if the 2-year yield, like percentage, if that gets higher than the 10-year, you're starting to see an inverted yield curve. And of course, that signals recession ahead. So stocks won't like that either. So that's the US 10-year yield. The bond itself, I showed this chart last time, and we saw that we had 2016 lows when we got to this green zone. 2018 lows, guess what? We're back to the green zone. 2021 lows, we're back to the green zone. And the question mark I put to everyone last week was this question mark here about, are we at 2022 lows? And you can see I talked about this wick right in here. It's called a wick when it comes down and returns back up. But you saw that we actually really solidly went down and went into that green zone again. And of course, we're looking at the weekly chart here. You can see the big wick it's had, the bonds, which are inverse to those yields I just showed. Now we go to the daily chart. You can see that it actually went into the green zone. It's gapped all the way up here, tried to fall off the cliff again, but then rallied just here, okay, yesterday. So, you know, I also mentioned last week, as bonds go, so too does gold. And that leads us to, you know, where we are today. So here's our gold chart. I've shown this before in our last video. Last time we had a video, it was right here. So I guess you could say the date was 25th of January. That's right, it was Australia Day, so it was the 26th of January. And price was right where my marker is here. We spoke about either a breakout or a pullback. And I also mentioned in the video that I was very bullish gold. And of course, you know, if you looked at the video that I made and then watched the price action, you'd say that I was wrong. And yes, I guess I was wrong. But I also said in that video, if we do roll over, we'd come back down to about this 200-day support with this rising trend support, hit it, and then perhaps then we would go, because the fundamentals are bullish for gold. So, you know, in the end, the fundamentals have won out, and timing is everything. And so your perfect timing would have been, if you were going to trade gold, would have been to be buying down at these lows here, and you can see what's happened since. Now, I spoke also about this descending trend of lower highs as we worked our way down. We also talked about the number of short contracts for the bullion dealers, the swaps, and you know, as the price got lower, they still remained at 220,000 net short positions. They were only, I think, 187 short on this occasion, so nowhere near that 220 number. And I think the latest figures are about 157,000 short contracts at about where my cursor is. So I mentioned last time, for us to get to 220,000 net short contracts for those bullion banks, we are going to need to be somewhere up in this vicinity. That's just where it looks like it's heading. And you'll notice that that measures up with this rectangle, purple rectangle, but also these previous highs. That would be the obvious target for me if In fact, gold can maintain this breakout, as you can see by that big tall green candle, breaking this trend of lower highs. And that is significant, very, very significant. You can see here we're up $31 per ounce. Nice big move. It's not the biggest move we've seen. I would expect that next week, depending on what happens geopolitically with Ukraine and the emergency Fed meeting, we would see either this breakdown, which would be very bearish, and would probably, I think if that happened, we'd expect to see this breakdown here. Otherwise, I'm sorry, but we are going higher. And I would say first target is up here. At this point, if I can do some drawing a path here for the record, you know, it's something like this. Come up to this point here, pull back. Where to? It might be this previous high. So maybe something like this, and then off we go, which actually makes this one here void. It didn't work out. Okay, option 2 is the fail, which means, you know, we might peter around here a little bit, but then perhaps we roll over. You might get something like this, and then we break down. Likely. Oops. They're options. Either one. Could we just go sideways? Probably, but not likely. This has been a very long consolidation or distribution pattern. Either way, it's going to be a big move. Okay. The most likely outcome is upside because we've got the breakout. And so hopefully you're positioned for that. Okay, so I just also wanted to show you the same chart but for Australian gold. Okay, so I'm just going to click on this one here. This is in gold and Australian dollars that I'm about to show you. This one you're looking at is US dollars. You can see the price is much higher at $2,605 per ounce. And look at this big green candle. It's the same breakout, different trend lines involved, but we've got new highs basically, and certainly since, what's that, October. Okay, so we've got an upward trend. It's looking very healthy, very strong as we work our way higher and higher. And with the Australian dollar rolling over, you can see on the right here, if I can get it up, 2000, yeah, it was up $57 just yesterday. That's a really big move for gold. What's that, 2.25%? So compare that with the gold miners, and I think we've got a very, very bullish case. I think at this point I might just split this in two, and I'll just double check. Just bear with me while I make sure I've got all these things interval across there. That's good. Okay, so I'll put on here the XGD. Let me just open this up a bit. Okay, so that's September last year. So we're looking at the same time period, but you can see, you'll notice that my cursor, when it's here, it's also showing up on the other chart. So here's where the little hand is. That's the high in gold from, what's that, 17 November. And you can see here is the high in stocks. So what I'm saying here is that here's the high. You got a higher high here and a higher high today or last night. But with the miners, you've got a lower high and then a significantly, we're down here. You know, essentially what I'm saying is in terms of the rally for gold miners, we should be, if we're going to match up with this on the left, we should have a price somewhere up here at 7,100. So there is significant upside for Australian gold miners. And that's only in the short term since November. That trend has been in place really for over a year, where we've seen Australian gold going from down here, for example, going higher. I'll get it right. Here's that same location here. And you can see that, okay, so really good. Here is 5th of March 2021. Gold is up. Here is, where's the 5th? 5th of March in gold miners, price is lower. So really, even on the longer term, gold miners really should be somewhere up around the 8,300 mark. You know, that's 20 to 30% behind where it needs to be. And there are reasons for this. You know, for example, labour shortages have been a threat to operations. Um, Oil is a threat because that's the main source of fuel for a lot of the mining companies. Um, you've got operating costs that are higher across the board in terms of governance, environmental protection, royalties, etc. So they've really struggled. And in fact, you could argue that gold really needs to go higher in order for miners to maybe be on the radar of investors. Really, that's what was needed or is needed to send the miners higher. So probably in the next week or so, we should see a significant rally in miners, provided that gold price can hold up. And it looks like it can. In terms of targets for gold, just go back to our single chart view for gold. You're going to get resistance up here as represented by the volume profile. This is an obvious target at around $2,641 Australian. You could get a pullback. I'll get this up and running. So we could get up here, come back down here, and then head higher. Perhaps to these previous old highs over here would put us somewhere in the range of $2,700 odd per ounce, and that's what's required really to get those Australian gold miners going. And it's tried to break out a couple of times of this downtrend. This is Australian gold miners right now. It's not really held up too well, but really next week should see this thing pump big time. We'll see what happens with silver. Okay, silver, last time I spoke to you guys, I mentioned that down in these areas, we were starting to get net long by the bullion banks. I'm very pleased to be coming back to you guys to report that I think last time we spoke, I think the number was around 1,800 net long contracts. Well, prices rallied. Go to the daily. Prices rallied since that time. I think it was it was somewhere in this area in here anyway, but that we were at 157. No, sorry, is that right? No, 1,800 net long contracts. And just in about this point here, the report came out and we were net 4,000 long. So we actually gone long while the price rallied, which is the opposite of what normally happens. So I see huge potential for silver, more than gold. It will follow though, because you can see if we look at the trend longer term, if you can think about that trend we saw on the price of gold, you'll note that it did actually, let's drag this across here, it did actually break the downtrend. So in terms of the equivalent, silver should be around about here. It hasn't happened yet. It will happen. It will follow gold. It's just lagged. And I do expect we'll get a significant rally. Once we break through, realistically, probably that's Australian dollars. Hold on. Go back and look at the, this is US dollars. So next week, we should see this break out. And we should be heading up to, I reckon we'll see price get back up to this $28 mark. It'll have to take a break. It won't just get straight through it unless the physical demand for silver is so strong that it just gets completely overwhelmed. And that's a possibility. But once we get through there, I think we're heading back up to the old highs of, where is it? It's a long time ago now. Okay, over here. What's that? $50 an ounce. All right, so once we get through this resistance here, off we go. And it probably needs to do that really if it's going to match the physical prices we're seeing at the moment. So there you go. That's the silver chart. All right, well, thanks for listening. I think that's everything I wanted to cover in this week's video. Don't like to make these too long, but stay tuned. Thanks, guys.